What if I told you that everything you think you know about the Bitcoin halving is about to be turned on its head? Every 4 years, the Bitcoin network undergoes a seismic shift, an event that has historically sent shockwaves through the entire crypto market. But this time, in 2025, it's not just another cycle. This time, it's different. Forget the old playbooks and the predictable patterns. We're about to dive deep into why the 2025 Bitcoin halving could be the most unpredictable and potentially the most explosive one we've ever seen. We'll be looking at groundbreaking on-chain data and even hearing directly from the people on the front lines, the Bitcoin miners themselves. So, buckle up, because what's coming next could redefine everything. Welcome back to the channel, everyone. If you're new here, we're all about cutting through the noise and giving you the real, data-backed insights into the world of crypto. And today, we're tackling the biggest event on the crypto calendar, the 2025 Bitcoin halving. For those who might need a quick refresher, the Bitcoin halving is a pre-programmed event that cuts the reward for mining new blocks in half. This happens roughly every 4 years and is a core part of Bitcoin's design to control its supply, making it a scarce digital asset. Historically, these halvings have been followed by massive bull runs. The logic is simple. Less new supply hitting the market, with constant or increasing demand, means the price should go up. We saw it in 2012, 2016, and 2020. So, it's simple, right? Just buy Bitcoin, wait for the halving, and watch your portfolio soar. Well, that's where the story gets complicated. The big problem, the central question we need to ask, is, can we really expect history to repeat itself? Relying on past performance is one of the oldest traps in investing. The crypto landscape of 2024 is a completely different universe compared to 2020, let alone 2016. We have institutional giants like BlackRock and Fidelity entering the scene with their spot Bitcoin ETFs. We have regulatory frameworks being built out, for better or worse. And we have a global macroeconomic environment that's, to put it mildly, volatile. Inflation, interest rates, geopolitical tensions, these are all powerful forces that simply weren't the primary drivers in previous cycles. Believing that this halving will play out just like the others is like trying to navigate a new city with an old, outdated map. You might get lucky for a block or two, but eventually, you're going to get lost. The stakes are higher than ever, and simply hodling based on old assumptions might not be the winning strategy it once was. So let's break down what's truly different this time, and we'll start by looking at the on-chain data. On-chain analysis gives us a transparent look at what's happening on the Bitcoin blockchain itself. Who is buying, who is selling, and how long they're holding. One of the most fascinating metrics is the behavior of long-term holders. In previous cycles, we often see these seasoned investors start to sell off their Bitcoin as the price peaked after the halving. But this time, the data is showing something else. Despite the new all-time highs, we've seen asterisk before asterisk that having a first in Bitcoin as history, long-term holders are showing incredible conviction. The supply held by these wallets remains stubbornly high. This suggests they believe the price has much further to run. They're not treating this as the cycle top. They're treating it as the launch pad. Another critical piece of on-chain evidence is the exchange balance. In the run-up to previous bull market peaks, we'd see a massive influx of Bitcoin onto exchanges as people prepared to sell. This time, the opposite is happening. Bitcoin continues to flow asterisk out asterisk of exchanges and into private wallets at a staggering rate. This is what we call a supply shock. The available, liquid supply of Bitcoin for sale is dwindling. Now, combine this dwindling supply with the new, voracious demand coming from the spot Bitcoin ETFs. These ETFs are buying up Bitcoin far faster than it's being mined. And remember, the halving is about to cut that new supply in half. We're looking at an unprecedented squeeze. Massive, institutional demand chasing an ever-shrinking pool of available Bitcoin. This is not a repeat of 2020. This is a completely new market dynamic. But what about the miners? They're the backbone of the network, and the halving directly impacts their revenue. To get a real sense of the situation, we spoke to several mining operators, from large-scale public companies to smaller, private operations. Here's a quote from an interview with a mining pool manager. "Look, the halving is always a stress test. Your revenue gets cut in half overnight. If you haven't prepared, you're in trouble." In past cycles, a lot of smaller, inefficient miners would be forced to shut down and sell their Bitcoin to cover costs, adding to the selling pressure. But this cycle is different. The miners who survived the last crypto winter are incredibly resilient and efficient. They've spent the last 2 years upgrading to the latest hardware, securing low-cost energy contracts, and optimizing every aspect of their operations. He went on to say that while some selling is inevitable, the industry is far more mature. Many large miners have built up significant cash reserves or even Bitcoin treasuries to weather the storm. They've learned from past cycles. They're not just surviving, they're planning for growth post-halving. Another miner, running a smaller operation, told us, the game has changed. Before, it was about just mining and selling. Now, we're exploring other revenue streams. We're using our infrastructure for things like AI computing and data centers. The halving is still a big deal, but our business models are more diversified. We are not as forced to sell our Bitcoin at whatever the market price is on a given day. This tells us that the expected wave of miner selling pressure might be more of a ripple than a tsunami this time around. They are stronger, smarter, and better prepared than ever before. So, let's put all the pieces together. What is the solution? How should we approach this unique 2020 for halving? The solution is to update your thesis. It's to recognize that the old 4-year cycle playbook needs a serious revision. First, we have to account for the ETF effect. This isn't just retail demand anymore. It's a constant, programmatic buying pressure from some of the world's largest financial institutions. This creates a much higher price floor than we've ever seen before. Second, the on-chain data shows a level of conviction from long-term holders that is off the charts. They're not selling into this rally. They see the supply shock coming and are holding on for what they believe will be a much more significant price appreciation. Third, the miners are not the weak hands they once were. They are sophisticated, well-capitalized operations that are less likely to flood the market with cheap Bitcoin post-halving. When you combine these three factors, institutional demand, holder conviction, and miner resilience, you get a potent cocktail for a market that behaves very differently. The post-halving price action might not be the slow, steady grind up we saw in the past. It could be more volatile, with sharper moves. As this massive demand runs headfirst into a wall of illiquid supply, the price discovery phase could be much faster and more aggressive. This isn't about blindly buying and hoping. It's about understanding these new fundamentals. It's about realizing that the institutional adoption we've talked about 4 years is finally here. And it arrived right at the doorstep of the most significant supply shock in Bitcoin's history. This is the core reason why 2025 is truly different. The fundamental equation of supply and demand for Bitcoin has been permanently altered. So what does this all mean for you? It means that while the core principle of the having reduced supply remains the same, the context in which it's happening has fundamentally changed. The entry of spot ETFs has created a demand sink that we've never witnessed before, effectively front-running the supply shock. The on-chain metrics show a level of holder conviction that defies historical patterns, suggesting the smart money expects much higher prices, and the miners, the very producers of Bitcoin, are more resilient and strategic than ever. This isn't just another cycle. This is a paradigm shift. We are in uncharted territory, and that's what makes it so incredibly exciting. The old maps won't work here. You need to be looking at the live data, understanding the new players, and appreciating the sheer scale of the supply and demand imbalance that is unfolding right before our eyes. Thank you so much for joining me on this deep dive into the 2020 for Bitcoin halving. I hope this has given you a new perspective on why this time really is different. If you found this analysis valuable, do me a huge favor and hit that like button. It really helps the channel out. And for more data-driven insights that cut through the hype, make sure you subscribe and turn on notifications so you don't miss our next video. I'd love to hear your thoughts in the comments below. Do you agree? Do you think the old cycle patterns will still hold true? Let's get the conversation started. Thanks again for watching, and I'll see you in the next one.